Welcome. The market is at a really fascinating tipping point right now. There are these huge questions swirling about where we're all headed. So today, we are going to dive deep, look at the data, understand this tension, and figure out what it all could mean for our strategy looking out to 2026. Let's get right into it. This video is for educational purposes only and is not financial advice. Always do your own research or consult a licensed financial professional. All right, so here's our game plan. First, we'll tackle the market's tense standoff. Then we'll try to decode what a potential correction could look like. From there, we're going to zoom in on a case study with Netflix, explore the two very different paths a stock like that can take, and then wrap it all up with how to prepare for the opportunities that all this uncertainty might just create. Okay, let's set the stage. Right now, the S&P 500 is basically walking a tightrope. It's sitting on a really critical support level. You can think of this as a kind of floor, a price point where historically buyers have jumped in with a lot of force to stop the market from falling any further. So pretty much everyone is just holding their breath, waiting for a few key signals before making any big moves. So what is everybody waiting for? Well, in a word, the Fed. Now, the market has already kind of baked in an interest rate cut, but it's now looking way beyond that. The real focus is on the Fed's dot plot, which is just their forecast for rate cuts all the way out to 2026. See, investors are desperate for a dovish signal, a hint that more cuts are coming, but the Fed's been sounding a little more hawkish lately, still worried about inflation. And that clash, that's what's creating all the tension we're feeling right now. So, with all this tension in the air, it's no surprise that some analysts are now modeling a pretty significant pullback. But before anyone gets too worried, it is absolutely crucial to understand the full context of what these forecasts are really saying. The number being floated around for a potential S&P 500 correction is 20%. Yeah, that is a big headline-grabbing number. It definitely gets your attention. But what does it actually mean in practice? And this is the crucial part. The very same forecasts that are predicting this pullback also expect a strong recovery to come right after. So this isn't a prediction of some long, drawn-out bear market. It's more like a temporary reset that could create a major opportunity for anyone who's actually prepared for it. Now, that 20% figure isn't just pulled out of thin air. Some models actually see the S&P 500 rallying up to a peak around 7,100 first. A 20% correction from that high would bring the index down to about 5,680. So why is that level so important? Well, because it lines up almost perfectly with a major prior support level, a previous market bottom where a huge wave of buying stopped a fall dead in its tracks. The key takeaway here is this potential pullback isn't just a random drop. It's a drop to a historically significant level. Okay, so how does all this big picture tension actually play out for a single, well-known company? To make this macro view a little more concrete, we're going to zoom in on Netflix. It's a perfect example of this crossroads between a bold, long-term strategy and that nail-biting short-term uncertainty. You see, Netflix has proposed this massive strategic acquisition, and the long-term vision? It's crystal clear. Protect their competitive moat, keep valuable assets away from rivals, and create an absolute powerhouse of content for users. But in the short term, shareholders they're nervous. This deal would add over $32 billion in debt, dilute existing shares, and probably face some serious regulatory hurdles, all while paying a premium. It is a classic battle between long-term vision and short-term pain. And you can literally see this exact uncertainty reflected right on the stock chart. It's flashing a major technical signal that has meant completely different things in the past. This just perfectly highlights how market context is everything. Okay, so the signal is called a death cross. Now, I know the name is pretty scary, but it's really just a technical indicator. It happens when a stock's average price over the last 50 days crosses below its average price over the last 200 days. All it's really saying is that the short-term momentum has turned negative. But here's where it gets really fascinating. A death cross doesn't always lead to disaster. Far from it. Back in the weak market of 2022, a death cross on Netflix stock was a huge warning sign. And yeah, the stock fell another 50–60%. But at a different time, in a generally strong market, a death cross actually marked the exact bottom right before the stock rallied over 50% in a month. The point is, the signal itself is neutral. Its meaning depends entirely on the bigger economic picture. So, this brings us right to the core question, the one you have to ask yourself when you're analyzing any stock right now. Are we heading into a 2022-style recessionary environment? Or is the broader market still fundamentally strong and maybe just going through a bit of a pullback? So, how do you take all of this, the macro uncertainty, the potential for a pullback, those conflicting signals, and actually turn it into a strategy that makes sense? Well, it really all boils down to two things: preparation and patience. Here's one analyst's approach, broken down into four pretty clear steps. Number one, maintain cash reserves. You want to have capital ready for when opportunities pop up. Two, use analysis to identify those key support levels we talked about earlier. Three, focus on a company's long-term value. Think out to 2026, not the day-to-day noise. And four, consider participating cautiously. Maybe investing small amounts just to stay in the game while keeping most of your powder dry for a better entry point. Which leaves us with a final thought to chew on. In a market that is balancing on a knife's edge, is the biggest risk right now acting too soon, or is it missing the opportunity entirely? Thanks for watching this video overview on 15 Minute Investor.